Good afternoon, everyone. We're the 2026 St. Cloud State University CFA team. I'm Paula Albala, and these are Robby Feiring, Prieto Andreasen, Collin, Hess, and Avery Morton. We hold a buy recommendation with a 16.89% upside and a target price of $30.9 per share. Our recommendation is based on three theses. One, increase revenue streams, increase recurring revenue streams through membership and dues growth. Two, increase utilization, showing the upward trend experienced by the health and fitness industry. And three, a continued improvement in cash flows and balance sheet maintenance. Lifetime Holdings, headquartered in Chanhassen, Minnesota, operates over 180 athletic country clubs across the United States and Canada. Its mission goes beyond fitness. It's about empowering members to live healthier and happier lives. Inside each club, members find more than just free weights and cardio equipment by providing an all-in-one inclusive ecosystem. By blending fitness, wellness, and lifestyle, they position themselves as a health destination rather than just a gym. The health and fitness industry has experienced a steady and constant growth since the COVID-19 pandemic, and we project that it's now entering an even stronger phase, mostly driven by a higher consumer awareness around health. We're also forecasting a CAGR between 6 to 8% through 2030. In 2024, 25% of the U.S. population held at least one gym membership, and while the industry is dominated by multi-site operators such as Planet Fitness, Lifetime's continued investment in pickleball and other activities has provided them with a higher competitive advantage. Inside the gym industry, you can find three different models. One, traditional gyms. They are large facilities that offer a diverse amount of amenities. They go from high-value, low-price range gyms like Planet Fitness to premium operators like Lifetime and Bear Resorts. And then we have boutique fitness studios. They are specialized locations that focus on one type of gym membership, on one type of fitness modality. They have also been experiencing the highest growth in this segment in recent years. Lastly, digital or virtual platforms. They are tech-driven fitness solutions that remove the need for physical attendance. They had a big increase during the pandemic years, and now most traditional gyms, like Lifetime, have developed their own online platforms. As you can see on this slide, Lifetime's revenue has been able to keep increasing through periods of economic downturns. This, and their high membership retention rate, positions Lifetime in a good place for long-term growth. Now, I will pass it over to Robby for the ESG.
Thank you, Paula. For environmental, the biggest driver for Lifetime is their large physical footprint. These are large clubs, so the exposure is mostly energy use tied to day-to-day operations. The utilities are embedded in center operations, and the practical levers are HVAC optimization, lighting upgrades, and building systems. Bottom line, environmental isn't a thesis breaker for us. It's more of a monitoring item that can help protect margins and can avoid reputation risk. Social is the strongest part of the ESG story because Lifetime is a service business. It wins or loses based on the experience that members get each and every day. The KPIs are here to show the scale: a large membership, a large team, and a large footprint. The people are what really drive this: hiring well, training well, and keeping strong talent in the door. We think that this drives retention and overall drives revenue. Overall, social gives us confidence in our model. On governance, this is about accountability and alignment. The key detail here is that PSUs are tied to adjusted EBITDA over a multi-year window, keeping leadership focused on strong operating performance and not short-term moves. Governance is stable and aligned, which lowers the risk of poor capital allocation. Overall, ESG doesn't drive the recommendation by itself, but it gives us strong confidence in our model and gives us confidence in execution. I will now pass it to Jacob to talk about financial analysis.
Thanks, Robby. Our financial analysis began with Lifetime's revenue growth algorithm, as seen on the left. This highly predictable model forecasts 10 to 12% top-line revenue growth and is supported by four key factors, indicating that growth can be measured across all aspects of the business. These four factors are primarily driven from Lifetime's members and their memberships. Recurring membership dues and enrollment fees comprise roughly 70% of Lifetime's total revenue in 2024 and 25. We forecast membership growth at a 3.7% CAGR across our 6-year forecast. We then use this algorithm to support our revenue forecasting, which we see growing at a 12.8% CAGR across our forecast. Also highlighted are Lifetime's two largest expenses, center operations and rent, which we see growing slightly slower than revenue at 11.8 and 11.5% CAGR respectively. Shifting focus to the balance sheet, we've recently seen Lifetime take an aggressive approach in deleveraging the company. With the help of a booming net income, Lifetime's net debt leverage ratio has improved from 6.3 times in 2022 to 1.6 times in 2025. Another key driver behind Lifetime's deleveraging is the strategic use of their sale leasebacks. Since 2015, approximately 87% of new centers have been leased, and today, a total of 68% of Lifetime's centers are leased. In 2025, Lifetime completed 7 of these sale leaseback transactions, generating over $227 million in proceeds. These proceeds, along with operational improvements, led Lifetime to achieve positive free cash flow in Q2 of 2024. We deem this highly important as it enhances Lifetime's ability to fund its CapEx, particularly its growth CapEx, which consists of the land and the construction of their new centers. Next, I'll hand it over to Collin to walk us through the investment risks.
Thanks, Jacob. From our analysis, we identified 5 main risk factors that will affect Lifetime's performance in the future, and we graded them using a matrix based on the probability of the event happening, multiplied by the impact it'll have on the business by our estimates. Rising real estate costs is the highest. Lifetime drives to expand into large centers, which are directly affected by higher property and leasing costs. This will in turn affect their margins and their ability to further expand into the future. Lifetime is also highly sensitive to interest rates. With their expansion strategy, an elevated interest rate market will slow new center openings and delay other capital investments. With their capital-intensive structure, Lifetime's profitability and performance is directly tied with the interest rate landscape. The fitness industry is also always evolving. With new boutique studios, at-home alternatives, and digital platforms on the rise, Lifetime's ability to adapt into these new areas will be crucial for their performance and market share in the future. Lifetime's workers are also not unionized. However, if they do unionize in the future, it will raise their costs and shrink their margins. And finally, global events such as the COVID-19 pandemic hold a low probability of happening, but hold huge impacts on the risks it has to the performance of the business, as seen with the revenue and the memberships in 2020. Failure to adapt to any of these risks or challenges, find new customers, and maintain current members is crucial to Lifetime's performance in the future. I'll pass it to Avery for our evaluation.
Thank you, Collin. Our evaluation of Lifetime is based on our discounted cash flow analysis with our supplementary relative valuation framework using the EV to revenue and the PE multiple. Our discounted cash flow analysis provides us with a target price of $30.94, with our base case seeing low, double-digit revenue growth guided by management, while operating expenses continue to follow historical trends with slight increases each year as the business continues to grow. Our WACC was calculated at 8.47%, representing Lifetime's low after-tax cost of debt and 9.58% cost of equity. Our 9.9 times EV to EBITDA multiple was derived by taking the 2025 expected EV to EBITDA multiple of our median peer set. Our supplementary relative valuation framework price target was derived by taking 50% of our EV to revenue price target and 50% of our PE price target. This allows us to capture the subscription nature of the business as well as the equity portion of the business. Our comparable companies were selected based on their competitiveness in the fitness industry, service and products provided to members, and their revenue makeup. Once again, we want to reiterate our buy recommendation of Lifetime with the price target of $30.94. Lifetime's unique resort-style athletic country clubs position them as a leader in the health and wellness industry, with their loyal, affluent members serving as the backbone for consistent revenue growth for years to come. With that, we conclude our presentation and want to thank the CFA Society of Minnesota and the judges for their time here today. Thank you.
So one of the things that you talked about was net debt, and they're reducing net debt, and they're increasing their equity. They're increasing their valuation by reducing debt, and then you also used as one of your valuation methods EV to EBITDA. So they're using a lot more rent, they're not owning, but how do you adjust for rent? Because it's not a free lunch.
Adjust for rent in the model?
Yeah, like how do you adjust for rent when you do EV? How do you adjust for rent when, yeah, net is declining, but how about rent obligations?
In this model, we didn't really adjust anything for rent. We just did it straight up EV to EBITDA.
Okay, thank you.
You mentioned interest rates as a risk factor, but also wondering if you had a chance to think through, since there's a large financial engineering component here of sale leaseback, right? Somebody's buying this property. So in a commercial real estate transaction, there's a valuation metric usually called a cap rate, right? Which is a rate of return. Interest rates have a huge impact on what that cap rate could be, which would affect the future cash flows from sale of those properties. Did you try to evaluate or stress test that whole equation since it's so important to the model?
On this specific risk factor, not really. A lot of this chart is just based on our estimations, reading through company reports and our analysis, but we didn't go through any stress test.
Was there any way to get a profile on transactions that have already been done and what the cap rates were when those properties were sold?
Looking through them, I was not looking through this, at least coming around to the paper. I was not able to find stuff on cap rates and didn't look too deep into it.
I'm going to hog one more. You did mention the growth of boutique competitors, right? And this is sort of the regional shopping mall model versus the boutique mall model, right? What were your other thoughts about the comparative attraction of either of these two business models?
Boutique fitness studios, they just specialize in one model. So like yoga, Pilates, sorry about that. Lifetime, they include those activities into their business model. So I believe that even though they have the highest growing, or they're growing the highest on the segment right now, Lifetime, by being able to include those into their model and as well as providing other like offers that a traditional gym does, they have that competitive advantage.
So on one hand, I think your ESG analysis, you focus on the healthy people, the talents they have. On the other hand, on your risk, you only focus on the union, labor union. I'm just curious, like, what if even without union, don't you think the labor cost would be higher going forward? Or because I feel like your assessment for like that labor union is a little low.
We believe that the labor union cost, that when we visited the clubs and they have a large number of employees at every club, we visited 4 locations: Lakeville, Rosemount, St. Louis Park, and I forgot what the other one was. And I think that it's a necessity to have that much labor in each one of those clubs to have the experience for everybody in the gym.
I think piggybacking off of Robby's point, you see a lot of large corporations that go through union negotiations when that stuff happens. And Lifetime really likes to take care of their people, their employees, their customers, or their members, apologies. And if that were to arise that, they wanted to unionize and start doing that, I think Lifetime would take a very swift action and, bring a package that would be suitable to their employees very quickly.
Hey guys, talk to us about risk versus reward on this name. So you've got 16% upside and you're calling that a buy. Given where the rest of the market is in terms of opportunities, how do you kind of justify what you're paying for the opportunity set and the relative skew of the risk?
Mm-hmm. Our analysis, although the valuation supports a buy recommendation, is mostly due to qualitative factors that we saw in the business, such as their unique resort style. When we go there, you're greeted by a concierge. It's such a different business that we think it deserves a spot in a portfolio and constitutes a buy recommendation. And the risk to reward is quite low on this recommendation, where right now the stock price is relatively at a low price for us, and the buy recommendation at $30.94, I think for us is a buy recommendation with very little risk.
In the ESG analysis, there was a comment that the PSUs were based on adjusted EBITDA. Do you know what the adjustment was?
We have looked at adjusted EBITDA. I can't bring it off the top of my head right now.
Maybe just talk a little bit about that reward structure and what is your opinion of that reward structure relative to what it might otherwise be?
I'll start. I think that it really, leadership is focused on strong operating performance, which I think down the road is going to benefit the overall valuation of the company, and the stock price will drive forward because of that. They're not focused on short-term outcomes, they're focused on long-term performance.
But I guess to lean on you a little bit, that looks like a metric that is highly gameable and could put management in a position of heads they always win. How does the shareholder get rewarded when there's no return on capital requirement, no margin requirement, no growth requirement?
Sorry, can you repeat the question, just the last half of it?
The lack of other potential ways to measure management in order for them to get paid. One of the things that's missing here in a business that you've already identified has a lot of leverage in it and has financial leverage and a lot of financial engineering. There's no return on capital requirement or hurdle in the compensation structure. And EBITDA is a fairly fuzzy metric, but adjusting it is even fuzzier metric. You know, how does that tie out to a healthy governance proposition for the shareholder?
Specifically, the adjusted EBITDA probably isn't the best for them to measure themselves on. As you said, a lot of variability and adjustments can be made. We have seen other companies use net debt, and if Lifetime were to start using net debt as their leverage, for their PSUs to be tied to, we think that's probably a better metric for them, a little less volatility, and it just gets their balance sheet in order.
Based on all the work you've done here and learning about the company and the competitive landscape, if you had a quick 30-second elevator ride with the CEO, what would you suggest to improve the business?
I would suggest for them to probably expand more into their urban-like, a little bit more higher affluent country club memberships. Right now we see, at least in Minnesota, a lot of memberships that are, a lot of centers that are more recreation style, basketball courts, pickleball, like you'd see at a YMCA. I think their opportunity, which I'm sure they're probably working on, is to get into New York, Arizona with a little bit more upscale, rivaling more of an Equinox gym.
I'll just ask, I'll follow on that question. If you'll get out of school and you'll be making a lot of money, how many of you think you'll choose the Lifetime version of an athletic club versus a boutique?
If I were to have a membership, I would pay for a Lifetime membership if I had the money. Right now, not so much in college. But yes, I think there's a lot of value there. You get classes, you get weights, you get Life Cafe, you get restaurants in some of them. I think it's well worth it.
I do agree with him. I feel like Lifetime offers you the opportunity to mix and match however you're feeling on the day. If you only had a boutique fitness studio membership, you would need to pay for another one at another gym club if you wanted to just lift weights. So I feel like Lifetime offers you that opportunity to just choose whatever you're feeling that day and keep moving on with your healthy life.
Everybody, oh.